In early 2016, the Financial Accounting Standards Board, or FASB, issued a new standard to improve financial reporting about leases. Leasing is an important activity in business. Many companies and other organizations lease assets, such as real estate, airplanes, trucks, ships, and construction and manufacturing equipment.
The new standard attempts to convey in a neutral and balanced way the true economic position that an entity enters into when it obtains access to capital in the form of a lease, that is, representing on-balance sheet liabilities that a company incurs. The problem with current GAAP in terms of lease accounting is relatively simple. It's the unrepresented obligation on the balance sheet representing the right to assets and the obligation to pay for that right. In 2006, the FASB and the IASB began a joint project to take a look at improvements to both US GAAP and IFRS as it relates to leasing. The goal of those projects was to both improve and converge the existing set of standards to reflect lease obligations on a company's balance sheet.
The leasing project being added to our agenda was also consistent with identified problems in an SEC study in 2005 on off-balance sheet financing. In that study, the SEC identified leasing as the largest off-balance sheet financing transaction with $1.25 trillion of liabilities in leasing off-balance sheet at that time period. We issued 3 documents, one discussion paper in 2009, an exposure draft in 2010, and another exposure draft in 2013. We did extensive outreach on all 3 proposals.
The board's extensive outreach as part of the Leases project included more than 1,700 comment letters, 200 meetings with preparers and users, including private companies and not-for-profit organizations, 500 meetings with financial statement users, 15 public roundtables with diverse stakeholder groups, 15 preparer workshops, and 14 fieldwork meetings with preparers from various industries.
Most of the feedback that we received when we issued the 2009 discussion paper and the 2010 exposure draft was general agreement that leases should be recognized as assets and liabilities by lessees. However, many stakeholders raised concerns about cost and complexity. And so what we tried to do in the redeliberation process is address those concerns. The result of that redeliberation was the 2013 exposure draft. Following that, we went through a very similar process of analyzing feedback that we received from a wide range of stakeholders. Some additional concerns were raised, and we tried to address all of those concerns in what ended up being the final leases standard.
Stakeholders expressed agreement with the recognition of assets and liabilities for leases on a general basis, but objected to the expense recognition for operating leases. In 2015, the FASB voted to keep the current model for expense recognition. That is interest expense and amortization expense for capital, soon to be called finance leases, and straight-line rental expense for operating leases.
Users asked us for additional disclosure of aspects of accounting that is unique to lessors, particularly risks that are unique to a lessor, including the residual risk that a lessor has in the underlying asset. In response to those concerns, we've added disclosure to enhance a user's ability to understand those unique risks. Additionally, we made improvements to the lessor model by making the lessor model more consistent with the recently issued revenue recognition guidance.
During outreach with investors and creditors, we learned that many investors were already making adjustments both to the balance sheet and to the income statement. In terms of the balance sheet, they were already putting assets and liabilities on the balance sheet. And in terms of the income statement, some were actually computing interest on the liability related to leases. So we think, given those adjustments, we think much of the concerns that have been expressed about the economic impact are unfounded. This will not be a surprise to investors. It's frankly just aligning the accounting with the economics as viewed by the users today. In addition to aligning the accounting with the economics of leases, the real improvement here is that we're replacing I'm going to call it a rough estimate of the assets and liabilities, taking 6 times lease obligations and putting that up on the balance sheet. The real improvement here is that it's going to be a more refined measure of the contractual obligations underlying the leases, And that measure will be more precise in terms of changes in business models, changing in leasing strategies, and that will in turn give investors better information.
I think the new leasing guidance is also a win for financial statement preparers. It better reflects the underlying economics of the activity they engage in. We completed the project in a way that allows preparers to leverage existing systems, that is, keeping in place the characteristics of operating lease accounting as well as the distinguishing characteristics of capital lease accounting.
For more information about the Leases ASU, visit FASB.org.